At this exact moment, Datavault AI Inc. is trading at $1.76, down roughly 10 cents or 5.36% for the intraday session. If you are glancing at this quote on your mobile screen, perhaps while scrolling through a watch list of sub-$5 flyers, you might be tempted to write this off as just another volatile day for a micro-cap stock that can't decide which direction is up. A 5% drop usually signals weakness, a crack in the armor. But what you are seeing on the surface, a red candle in a sea of noise, is actually a classic case of sell the news profit-taking after one of the most aggressive guidance updates we have seen in the small-cap tech sector this year. The expectation from the broader market, the street consensus, is that Datavault is a confused company, a former audio tech firm that pivoted to AI and blockchain just to catch a hype wave, effectively throwing buzzwords at a wall to see what sticks. They expect this to be a vaporware story that will fizzle out once the retail enthusiasm drains away. The reality, however, is that this company has just signed a definitive agreement to tokenize $125 million worth of geothermal energy assets, effectively positioning itself at the bleeding edge of the real-world asset, or RWA, movement. The disconnect between a market treating this like a pump and dump and a management team securing 8-figure revenue contracts is the exact friction zone where you need to be paying attention. When you see a stock like Datavault AI hovering at $1.76, you are looking at a company that is essentially a call option on the convergence of 3 distinct sectors: artificial intelligence, blockchain, and industrial infrastructure. The drop of 5.36% today is largely mechanical. We just saw the stock pop aggressively on the news that they raised their fiscal year 2026 revenue guidance to a staggering $200 million. Whenever a penny stock gaps up on news like that, the day traders and the algorithm bots immediately step in to scalp the volatility, selling the rip. That is why we are down today. It is not because the fundamental thesis broke, it is because the short-term liquidity is churning. But if you look past the red percentage, the volume profile tells a different story. The volume is elevated, suggesting that while the flippers are exiting, a new class of investor, one interested in the long-term mechanics of asset tokenization, is starting to accumulate positions. This handover phase is often messy, and it creates these jagged price charts that scare away the timid. If you are actively trading this on the Robinhood app or managing a high-risk allocation in your SoFi active investing portfolio, you need to understand the specific mechanics of the Triton geothermal deal because it is the Rosetta Stone for understanding this company's future. The expectation was that Datavault would make money by selling software licenses, a slow and steady grind. The reality is that they are becoming a merchant bank for data. By tokenizing Triton's geothermal assets, they are converting physical, heavy infrastructure, holes in the ground, steam, turbines, into liquid digital tokens that can be traded. They are charging a massive fee for this, up to $8 million in tokenization fees, plus a percentage of future transaction volume. This is not a software subscription. This is high finance engineering using blockchain rails. The market is currently struggling to value this because there are very few public comparables. Is Datavault a tech company? Is it a crypto exchange? Is it an investment bank? This identity crisis is what pins the price below $2, but it is also what gives it the explosive upside potential if they prove the model works. I want you to pause for a second and really think about this RWA concept. Comment below with your take. Do you believe that physical assets like real estate and energy grids will eventually all be traded on the blockchain, or is tokenization just a solution looking for a problem? I am genuinely curious to see how many of you trust the digital twin narrative versus those who think it's just unnecessary complexity. Let's dig into the legacy business, because this is where the skeptics have the most ammunition. Datavault didn't start as an AI company. They essentially morphed from a company deeply involved in acoustic science, owning patents related to WISA, wireless speaker and audio. The expectation is that this is dead weight, a remnant of a failed business strategy. The reality is that they are creatively repurposing this IP. They are using their spatial audio tech to create digital twins for the metaverse and spatial computing environments. If you want a realistic AI simulation, you don't just need it to look right, you need it to sound right. Sound waves interact with physical objects in complex ways. Datavault's Sumerian and ADO technology models these interactions. By combining this acoustic fidelity with their new data valuation tools, they are pitching a holistic, I know, but it fits here, simulation engine. It is a weird, eclectic mix of assets, but in a world where Apple is pushing the Vision Pro and Meta is pushing the Quest, having a patent portfolio on how sound moves wirelessly is not a bad card to have up your sleeve. The market assigns almost zero value to this legacy IP, treating it as a distraction. The contrary take is that this IP is a dormant volcano of licensing revenue waiting for the right spatial computing hardware to scale. For those of you using fidelity brokerage services or looking for investment help, you have likely been warned about reverse merger types of companies or microcaps with frequent name changes. Datavault fits that profile of a shapeshifter, which is a red flag for traditional value investors. However, the reality we must confront is the sheer scale of the numbers they are putting on paper. You do not guide for $200 million in revenue unless you have a pipeline that is bursting at the seams. This is a company that was doing a fraction of that recently. To jump to $200 million implies that the Triton deal is just the tip of the iceberg. They are signaling that they have cracked the code on selling data value. They aren't just selling tech, they're helping other companies figure out what their data is worth and then selling that value to third parties. In the age of large language models, data is the new oil. Companies are realizing they are sitting on gold mines of training data but have no way to sell it. Datavault steps in as the broker. They clean the data, verify it, tokenize it, and sell it. If they can successfully position themselves as the NASDAQ of data, the current market cap is a rounding error. Now, let's discuss the Philadelphia move. It sounds boring. Who cares where the headquarters is? But in the world of microcaps, corporate actions signal intent. Moving to a new, larger headquarters in Philadelphia and bringing the team back to an in-person culture is a sign of maturation. The expectation for a crypto AI penny stock is a distributed, remote team of contractors that disappears when the money runs out. The reality of signing a 5-year lease and consolidating operations suggests they are building a real corporate infrastructure. CEO Nathaniel Bradley has been very vocal about chopping wood, getting the hard, unglamorous work done. This shift in tone from hype to execution is subtle, but for an observant investor, it is a critical differentiator. They are trying to look, act, and operate like a blue-chip firm before they actually are one. If you are looking at the charts on your Interactive Brokers trading platform, you will see a lot of wicks on the candles. Long upper wicks, long lower wicks. This indicates high intraday volatility and a battle between buyers and sellers at every price level. Today's drop to $1.76 is testing the support established before the breakout move. If it holds here, it builds a higher low, which is the definition of an uptrend. If it breaks below $1.60, the chart turns ugly again. For the technical analysts, this is a retest of the breakout zone. The bulls need to step in right here. If you are looking for an entry, this pullback is technically the spot where the risk-reward is most favorable, allowing you to place a tight stop loss just below the consolidation zone. We also need to talk about the energy angle. The Triton geothermal deal is not random. AI requires massive amounts of electricity. Data centers are sucking the grid dry. The expectation is that big tech will just build more solar panels. The reality is that solar is intermittent. AI needs baseload power, power that is on 24/7. Geothermal is one of the few renewable sources that provides baseload power. By financing geothermal projects through tokenization, Datavault is effectively financing the shovel sellers of the AI gold rush. They are not building the data centers, they are financing the power plants that run the data centers. This is a second derivative bet on AI that is much smarter than just trying to build another chatbot. The market hasn't fully priced in this AI energy nexus narrative for Datavault yet. They still see it as a tech stock, not an energy infrastructure play. For the average person using investment sites to research this, you might see a strong buy rating from a single analyst or an algorithm. Be very careful with those. In the microcap world, analyst coverage is often paid for or extremely thin. You have to do your own diligence. The reality you need to verify is the cash flow. The press releases talk about revenue opportunities and potential fees. You need to watch the 10Q filings like a hawk to see when that cash actually hits the bank account. Revenue recognition in the world of tokenization can be tricky. Does the auditor accept the tokens as revenue? Do they have to convert to fiat first? These are the accounting landmines that can